Previously, to do something like this, you had to be an accredited investor.
Yeah, the SEC had this framework under Regulation D, Rule 506B, that allowed you to, as a company or as an issuer, go out and raise money strictly from accredited investors. You could not publicly advertise those, so it had to be a relationship with somebody that you had, or a friend of a friend, some sort of pre-existing relationship. You couldn't just put an ad on TV or buy a billboard ad and raise money. With the Jobs Act, several changes were made to that. So they added Rule 506C, which now allowed for public solicitation and advertisement for these private offerings, which again was still limited to accredited investors. There was Title III of the Jobs Act, which created crowdfunding for non-accredited investors. And there was also Title IV of the Jobs Act, which created this Regulation A+ concept, which was also targeted towards non-accredited investors.
Interesting. Give us an idea of the profile of investors that were putting their money into a Sharestate project.
When we first started, very much like what most companies do, we went to friends and family. It was a new concept. And admittedly, we thought it was going to be a lot easier to get this thing off the ground than it was. We had this idea in our minds that if you build it, they'll come. Who doesn't want to invest in real estate? If you could spend $1,000 and participate, why wouldn't you? We realized after we built the platform and took our website live that it wouldn't be nearly that simple. You're going out into a broader audience of people that don't know you, have never heard of you, have never heard of your company. The company itself has a very limited online track record, so there isn't a whole lot of information that you can really look up on it. And you're basically asking people to give you money as an investment. Somebody you don't know approaches you with something like that for the first time, you're going to be skeptical. We had to pivot a little bit. We realized that in order to really build a platform that's going to have hundreds of thousands, if not millions of dollars flowing from individual investors, we first had to make the platform look legitimate. And the best way to do that would be to scale the business, give it a track record, give it a history, show performance. And the best way to do that would be to go to institutional investors. Back in 2015, we had to pivot for a short time and really focus our attention towards bringing in institutional investors, which helped build our track record. And then eventually we brought back in those crowd investors. So today we're about a 60-40 split, with 60% of our capital coming from larger institutional partners and 40% coming from the crowd or the syndication side of the business.